In this video, I'm going to talk about what to do prior to a market correction, during a market correction, and some things to think about post-correction. And of course, unfortunately for retirement investing, corrections are a reality from time to time. And particularly during times of economic uncertainty, geopolitical events that create market volatility, it really puts our focus on our retirement portfolios. And for good reason. You have less time on your side. You've got less buffer room. At the time that markets are correcting, you also have to take money from your portfolio. And so this is a really important topic. And I'm going to talk about how do we get out of this feeling like we're like this ship on the ocean or we're being buffeted back and forth by winds and waves. And there's all these competing voices speaking to us about what we should be doing. And in this environment, we begin to take some mental shortcuts and emotional shortcuts that can actually hurt us. And I want to talk about some of those shortcuts in this presentation, how to fight against them. And we're going to talk about a specific process. So we'll talk about process, guardrails, and tripwires as key strategies to get through periods of market volatility and prepare for market volatility because it's going to come. Now, why do we go through the pain and suffering of bear markets? And I will tell you, they are a reality. I know there's lots of information being sold and created to help people get the bull market returns, but to never get stung by the bear. But getting stung by the bear is a feature of investing. It's not a bug. And so why do we do it? We do it because long-term equity markets perform really well. They add significant value to our wealth. And so the facts are, if I go from 1926 to 2024, a dollar invested in 1926 in small cap stocks, it grew to an amazing $39,224. Large cap stocks grew to $18,199. Long-term government bonds, $128. T-bills, cash, $24, like nothing. So getting these kinds of above average returns helps us cope with inflation, taxation, maybe generates more wealth for income generation, and maybe legacy creation for our families. So that's what we go through this exercise. Now let's talk about some behaviors that get in the way of being successful. We do know that there is a behavior gap. This particular chart is data from 1992 to 2011. It's an old study, but it's still relevant, right? IFIC did the study. They looked at the average stock mutual fund returns for Canadian investors over that time period. They averaged 8.2% compounded returns net of fee. The average return of investors buying those same mutual funds averaged 3.5%. And the authors of the study called this the investor behavior penalty. And you don't have to be an investment genius to know what was going on. People were selling low, buying high. They were chasing returns, and they were blowing up their performance over time. JP Morgan did a study looking at average investor performance. It was underperformance. So over that 20-year period from 2002 to 2021, you could see that REITs had astounding performance, 11.2%. And then we saw S&P 500, 9.5% compounded returns over that time frame. Balanced portfolio, 7.4%. And down we go here, the average investor, 3.6%. So study after study does confirm this underperformance. We're going to talk about some of the things that are happening for individual investors that are leading to the underperformance. So the first area is cognitive and emotional bias. Crowd following is one for sure. So there could be investment themes, investment ideas. The best minds in the business, particularly in financial services, are trying to create products that appeal to our anxieties, whether it's guaranteed income, consistent cash flows, dividend-based strategies. And a lot of these strategies are thematic, but actually hurt investors long-term. They leave a lot of money on the table because they're appealing to one particular concern. So following the crowd is a big one. Overconfidence. I've seen that a little bit. There's a little bit less of that now, but over the last few years, investors have gotten into the markets, and it's pretty good timing. Low interest rates have driven up capital markets, create a lot of liquidity in the markets. And I think some folks think that some of their success from an investment standpoint was because of them. And unfortunately, quite frankly, it was because of timing and quite a bit of luck. But the two things happened at the same time. They made certain decisions. Those decisions have done well. They've taken credit for it. And they haven't gone through significant volatility. And there's a little bit of overconfidence. They're not relying on process, guardrails, or tripwires. They're just gut feel and intuition, and it's worked out for them. And then we have loss aversion. We weigh loss far more heavily than gain. Psychologists often say 1 unit of loss, the equivalent would be 2 to 3 units of gain. And as a consequence, we overreact to losses out of proportion to what they really mean for us, and we need to fight against that. And then family of origin is a big one. Our own personal experiences, our family experiences, those inform our biases and how we approach our portfolios. The other thing is we get a little bit complacent. And this chart is a great example of how complacency can develop. We've got this time period here, 1952 to 2024, 57 positive years, 16 negative years. So the market was up 78% of the time. That's a green here. And then you have the negative years in the red. And because the market is up most of the time, that's where that complacency begins to kick in. So again, if I go back to my previous point, there have been up until recently a lot of complacent investors because the market in general has been doing pretty well. And that can set us up for failure because we really don't either know what true volatility is, or we haven't put in place defensive strategies to anticipate that volatility coming into play for us. Now, the other thing is, on average, it looks like there's some predictive patterns for investors when they look at the markets. This is a great chart. Now, this chart, bull and bear, is another chart that illustrates how complacency can come in and how people think there are patterns that they can exploit successfully, and they're really not patterns at all. So if you look at the S&P 500 from the mid-40s through to 2024, the average bull market was up 139%, and the duration was 57 months. The average bear market was down 29%, and the average duration was 15. So if you look at the chart here, you can see the average bull was way longer and way higher than the declines of the average bear and the duration of the average bear. So why all the concern? Again, we get back to the psychology of investing. The response by the markets and the headlines is just crazy when there's market volatility because they know that's going to get your eyeballs. And then on top of that, when you look at this chart, it looks like you could actually navigate this volatility. I might be out of the market during the initial phase of the bull market, but I see that there seems to be a pattern here that I can exploit in my portfolio. So it creates this false sense of pattern recognition that really isn't there. Let me just show you a chart that illustrates this. S&P 500, 1988 to 2019. So if I go back to the previous chart, that's basically here through to this time period here. Now, if you look at this chart, it looks like there is some pretty consistent growth in the market. What's interesting is the 20 best days in green were stacked up right against the 20 worst days in red. It would be very difficult to figure out what the pattern is. Nonetheless, there were more incrementally good days than bad days, so that over this time period, the market had returns in the range of 10% a year. How in the world, if you're trying to be in the market or out of the market, are you going to get the timing right on this? This is another chart that illustrates the same kind of thing. The best trading days, the worst trading days are stacked up against each other. 12 of the 20 best trading days occurred in the years with negative returns. 8 of the 20 worst trading days occurred in years with positive returns. Again, if you're trying to read the economic tea leaves, it would be very difficult to get that one right. And this is a shocking chart speaking to how few days actually drive most of the return in the markets. So if I look at this information that Franklin Templeton put together, if you look at the broad stock market in the US and you look at the trading days, if I put $10,000 in the market from 2005 to 2024, and there were 5,033 trading days over that time frame, my portfolio would have grown to $71,750, a compounded return 10.35% on that portfolio. If I had missed the 10 best days over that 5,033 days, my return was 6.14%. I had $32,000 basically in my portfolio, down from $71,750. And if I'd missed the 30 best days, basically I've got 12,948. My compound returns 1.31%. There are so few days that lead to the returns that we're shooting for in our growth or stock portfolios. How in the world would any investor be able to trade in and out in the midst of this market volatility that you're seeing on the screen? You can't do it. So this is the great conundrum. How do we get market returns that we're aspiring to in the context of all this short-term volatility and acknowledging the fact that there's only a few days to drive most of the performance? What are the strategies that we should be using? And I'll talk about that certainly in this presentation. Now, the one that I'm hearing about quite a bit is the markets are expensive. Surely that we're on a cliff right now in terms of the market. I'm going to sit in cash and I'm going to wait until the market corrects and I'm going to jump back in. Now, again, what I've shared with you so far should dissuade you of the efficacy of that strategy. But let's look at this. Is there a correlation between how expensive a market is to how it performs at the peak of that expense. So if you look at the research here, many investors may think a market high is a signal stocks are overvalued. However, they may be surprised to find that the average returns 1, 3, and 5 years after a new month-end market high are similar to those after months that ended at any level. In looking at all monthly closing levels between 1926 and 2024 for the S&P 500 index, 31% of them were new highs. After those highs, the annualized returns ranged from almost 14% 1 year later to more than 10% over the next 5 years, which were close to the average returns over any period the same length. So what you see here is on this sort of greenish color, after months of recorded highs, the 1 year return after was 13.7%. The average is 12.5 over all periods. 3 years later, 10.6%, 10.7 for all periods, and then 10.3% 5 years later. There is not a correlation between how expensive a market is and whether the market's going to do better or worse. Yet a lot of investors are saying that very thing right now when they look at their portfolios. And given what I've said before, you can't time this. It'd be very easy to leave the market, be in cash, and then miss those 10 days that lead to most of the performance that we're looking for. The other thing is that we're looking for predictive ability. We're always on the hunt for that brand new money manager or security that's going to, again, give us bull market returns, but sidestep the bear markets. This is looking at equity analysts from the major investment houses around the world, basically. This is the S&P 500 index in 2024. The actual index did 23.3%. And if I look at Goldman Sachs, I look at Deutsche Bank, RBC, Bank of Montreal, Bank of America, Wells Fargo, Scotiabank, Morgan Stanley, and JP Morgan, nobody was anywhere close to what the actual was. And this is a consistent theme. So the large institutions that are making hundreds of millions of dollars selling their research have very poor predictive ability. So what we know from historical data that active managers and those research firms that purport to know what the future is going to be in a very complex world, at some point they're going to guess wrong. And the world is too complex with all the best scientists and data gatherers to really know for sure what's going to happen with the market. And then another thing that happens is we know from the research that non-advised households or households that are taking a more simplistic approach to their planning experience financial leakage, or I'll call it opportunity cost, lost economic value in their planning. So the activities I'm going to share with you from this report, and this is research that is done every year. It's done in collaboration with Morningstar and Vanguard. They call it the Advisor Alpha Study. I'm going to flip the study back to non-advised households. So if a non-advised household that's doing do-it-yourself investing wants to experience the least amount of leakage financially possible, these are the activities that they should be engaged in. So they need to be their own behavioral coach. So what does a coach do? Accountability to make sure that things get done, encouragement when things get tough, right? And so you need to be really good at self-coaching and getting things done during times of stress and uncertainty. Comprehensive wealth planning, asset allocation rebalancing, accumulation strategies, portfolio tax management. All these categories are categories that typically a wealth advisor would be engaged in. And that adds to the total value of the balance sheet. So rather than focusing the discussion when it comes to bear markets on just your portfolio, focus it on more comprehensively on all these activities happening above the portfolio that will add value to your balance sheet and net worth position. And if you're not doing these activities consistently, you will experience significant financial leakage over time. And then there's a notion of pattern recognition. And essentially what we're talking about here is that if you were ever asked to be an executor or a power of attorney, how often have you done that role in the past? For many people, when they actually are an executor, it's the first time they've done it. And retirement planning and portfolio strategies for retirement are the same way. So you have a lot of people that are do-it-yourselfers. That's fine. They're doing this for the first time, and they don't have the experience of seeing many different circumstances and learning from those circumstances. They're an N of one. And one of the downsides to that lack of experience is sometimes poor decision-making can happen. And sometimes people are very isolated. So they're consuming information for sure, but they're in their own little vacuum around making decisions. And again, that can lead to subpar decision-making. So ultimately, we want a process that takes it from that ship that was on really rocky waters, the winds were blowing, the waves were high and rolling, to tranquil, peace of mind, calm waters. And so how do we move in that direction with our retirement portfolios? It gets back to process, guardrails, and tripwires. So the first thing we need to do is always have this two conversations going on in our planning. One is the overall conversation about our retirement plans, always reviewing the goals, updating the forecast, updating our tax situation. What was our actual against our planning? That process is really important. And that informs our cash flow plan and decumulation plan, informs our investment policy. So investment policy will define your timeline, return requirements, liquidity requirements, tax position. You want to monitor, you want to rebalance. So that's the first part. Secondly, you need to have a plan in place. So you should never be managing your portfolio in a vacuum. So just like those conversations are always happening at the same time, your financial plan will obviously inform your estate planning, your tax planning, your cash flow management, and your investment planning. So you always start with your plan. That confirms what return requirements you need. That then gives you direction on the deaccumulation strategy. So now at this step, we're looking at drawdown strategies between the RSP RIF, your non-registered TFSA corporation, if you have it, to maximize your after-tax income. That then informs your timeline. Money that's needed over the next 2 to 3 years, you want to be hyper cautious with. Money that's needed over the next 4, 5, 6, 7 years, you can take more of a moderate risk approach to your portfolio. And then money that's needed going out 9, 10 plus years, you can be more of a growth investor and take advantage of the opportunities that are embedded in high quality equities in your retirement plan. You also want to focus on this notion of risk premium. What we say to clients is, don't take on more financial risk than is necessary to achieve your financial goals and objectives. So the idea is, what is the required return? What is the risk-free rate? And then what is the risk premium I need to take on to achieve my goals? So if I needed a return of 7% per year and the current risk-free rate, like on GICs, was 3, that means I need to get a premium, a risk premium of another 4% to reach my goals. And then that determines the mix of investments that have a high probability of achieving those returns. So the notion of risk premium, and that's for each timeline. So this timeline will have a different risk premium because the objectives are different. That will define the investment strategy. The other thing is that asset mix is the single biggest driver of performance in your portfolio. So there's numerous studies, I've listed some here, that confirms that over 90% of performance between various portfolios are going to be determined by the asset mix. And that asset mix is also influenced by something called efficient frontier. So we'll use ETF strategies with iShares or Vanguard, two of the biggest asset managers on the planet. And they've spent a fortune developing asset allocation models that adhere to this notion of the efficient frontier. Don't take on more financial risk than is necessary to achieve the goal return. Retail investors cannot build efficient frontier portfolios anywhere close to the way that large institutional money managers can do it. So leverage off their expertise, use ETF structures designed and built by those large manufacturers, and leverage off the idea of cross-correlation, modern portfolio theory by Markowitz. And lots of research has been done by trying to find non-correlated assets to smooth out the pattern of return on your portfolio over time. And again, there's lots of great ETF solutions that leverage off that. So 70 years of investment research confirms the following. Your asset allocation drives your long-term returns and risk. Broad diversification applies the laws of probability to your advantage. You want to have broad diversification because you're not going to be able to guess correctly which sectors, which stocks, which geographies are going to drive most of the return. You're better off owning the broad market to increase the probability of success in your portfolios. No one's unhappy with the performance of the S&P 500 index over the last 10, 15 years. Broadly diversified, only 7 stocks drove most of the return. They're happy with that. They didn't have to guess which 7 stocks would drive the return. They just had to own the index. Focus on total return, not thematic investing. Don't get sidetracked with, I'm just going to buy REITs. I'm just going to buy dividend-paying stocks. Be a total return investor over the longer term. That's going to be the best approach for your portfolio. Do not take mental or thematic shortcuts with your approach. You can't time the market. I think we fully explained that one in this presentation. Current prices of securities reflect all known information. You cannot arbitrage the markets. Hyper trading speeds take place with the large institutions. They respond to new information immediately. You'll never be able to beat the experts in this area. If you do have an idea that's driven by gut or intuition, if it does well, it's probably because of luck, not because you've been able to outguess the traders that have the best trading systems and research available. And new information is immediately reflected. That's what I'm getting at. Hyper tradings and new information is taken advantage of by the traders with the large firms immediately. And active managers do not add value. So if you're trying to buy a mutual fund or a product that purports to add value, the SPIVA reports that look at the different active strategies confirm consistently that you're better off going with broad market ETFs in your portfolio. So our preferred option when we talk to clients about building their portfolios is low-cost index contracts. They're single trade tickets. They're simple. Simple is better for the vast majority of people. For non-registered accounts, they're tax efficient. The larger firms like Vanguard and BlackRock iShares, they receive so much new money every single day that when they rebalance their portfolios, they can do it out of cash flow. They don't have to sell or cannibalize assets within their ETF structures. When money managers do that, that can create distributions and tax complications for you. So you want to make sure you deal with the large managers so that doesn't happen. So when you build your mix, you want to have a broad market exposure to cash, real estate, bonds, stocks, and all the major stock categories, big, mid, small cap, geographic diversification, currency diversification. And you want geographic diversification because the studies again confirm that's how you drive better long-term performance. Don't get focused on one particular geographic area. So the best security mix by the large institutional money managers, they'll tend to be overweighted for Canadian investors to US and Canada. But if you look at the MSCI All Country World Index, from 2010 to 2024, it compounded at 9.8% per year. If you excluded the top 10 contributors, it only compounded at 6.8% per year. And if you excluded the top 25 contributors each year, you're down to 5.4%. So huge performance differences. Research shows there is no reliable way to predict top performers geographically. You want to own the broad market when you build your portfolio. And then systematic rebalancing is critical. Now, this is where we get into also the tripwire idea. So you set up your investment policy statement. You want to adhere to that mix. That triggers intentional, immediate rebalancing to maintain the integrity of the risk and return profile of your security for your portfolio. You also want to have a mechanism in place that through the year, you're doing your own profit taking and rebalancing in a portfolio. That is a very important component to the guardrails. You do not want to allow your risk assets to get a higher and higher percentage of your portfolio because now you're exposing yourself to too much risk. As a retiree, you want to protect those profits along the way. So have a mechanism to do that regularly. You also want to have year-end tax planning and profit taking as part of your discussions. You want to have tripwires. What are you going to do when you see a 20-25% market correction? What are the tripwire activities that you're going to initiate? What are you going to do when you see above average performance? Will you fall in love with your better performing investments, or will you rebalance and have the discipline to do that and protect the profits? Tripwires on the downside are critical because it triggers you to assess, do I need to adjust my cash flow? Do I need to reduce my draw on the portfolio? Do I need to use a line of credit short term so I take pressure off my portfolio? If I still can maintain my cash flow, do I use my line of credit to buy back into the market when the market goes down because there's good value? So think through your tripwires that trigger a response when those tripwires happen. You don't want to be trying to think through that on the fly. You want to think about those things in advance. So what are the corrective behaviors? Have a plan. Do you need stocks in your portfolio? That's the first question. If you do, use timeline investing to stratify risk by timeline. You want to have systematic rebalancing and tripwires in your portfolio, regular profit taking, and investment policy and tripwires need to be thought about in advance of a bear market happening. You want to fight against isolation. Ideally, you want to have like-minded people that you're talking to, maybe it's an investment club, people that you can share ideas with, because to be alone in this journey when there's market volatility and economic volatility is not a great place to be in. Computer stress testing is important. Usually that's done in the context of working with an advisor, but increasingly there'll be computer modeling that will help you to do that, Monte Carlo simulations, and apply the trifecta of risk management to your portfolio strategy and your wealth planning. Have a line of credit, have budget flexibility, make sure that you have a cash wedge or timeline one in your portfolio. There's a lot of pieces here, and if you're beginning to think about whether you have the time or inclination or expertise to implement on these ideas, in the show notes, there's information on our practice, free resources. You can always book an appointment time, 30-minute complimentary call to learn more about our process so you can experience peace of mind and confidence about your retirement portfolio and retirement journey. You take care.